The UK retail sales data has come out and it was weaker than expected. We're going to have a look at the reaction. And later on today, we have Eurozone inflation data coming out. We're going to see if a weaker inflation print can put a cap on the Euro rally that's been. And the Trading Takeout today is why you need to be brave when it comes to creating trade ideas and actioning a trade. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So a bit of a torrid day for UK retail sales. The year-on-year number was negative 2.7% versus an expectation of negative 1.5%, and the month-on-month negative 0.3% with an expectation of negative 0.3%. So big deviations there. And News Squawker have gone through the data, and they've said it's predominantly because of a fall in automotive fuel sales volumes, but also from both food and non-food stores. Non-store retailing, the only main sector to report sales volume growth in non-store retailing is online. That grew by 0.8%, I believe it says. Yeah, non-store retailing, predominantly online retailers. Sales volumes rose by 0.8% in October 2023, following a fall of 2.4% in September 2023. So a very mixed bag there of ways to interpret this, because mainly we're looking at, the increase in fuel prices as being, one of the largest drivers of this. People are buying less fuel because the price of fuel had spiked up, which I can definitely see there being a case for. I think it went from maybe about £1.50 a litre up to £1.61, 62, I think it is now for petrol. Diesel's more expensive, about 7 or 8p more expensive on top of that. So we're looking definitely at a bit of a crunch there, I guess. And what this would tend to mean to me is that demand generally is going to fall. So if people are driving less, they're going to be buying less, is pretty much what it comes down to. Now, they do say that the wet weather was a big contributor, and in the UK it's been horrible recently. It still is. I open my window now and it's actually raining right now this second. I don't remember a November being, or October even, being this wet before. Maybe I've just got short-term memory loss because of the pandemic, but I really, really don't. I think it's been really, really bad this year. So I can definitely imagine that reduced footfall has contributed there. And that probably does show in the rise in online sales as well. So, people are staying at home, just buying more off of Amazon. You can get same-day delivery sometimes, which is insane. But the pound fell by about 30 ticks. And it's now resting at, let's have a look very, very quickly. So if we share here, it's now resting at 1.2384%, but this is quite a nice bottom here. See, we've taken the lows, all of these lows, and do you remember what I said about yesterday about buying lows and mean reversion? So by the time this video comes out, it's probably going to be a done trade, but this is a great example of looking at a low where the buy-in has come in quite strongly after, and then you can potentially look at ranges higher and see, okay, there's one range, and then there is another high here that you could potentially look at. So there's two different ranges there, but point of origin, big steep drop off, lots of supply there, lots of people wanting to sell. Mean reversion could suggest that it comes back by about, I don't know, 30 or so ticks again. So definitely one to watch out for, just to prove that concept, because this is happening in real time. If it doesn't happen, then we'll delete the video. But yeah, not great for the UK there. And I think the Bank of England might take some pause. They've already brought forward rate hikes a little bit, or at least they've brought forward rate cuts, or at least rate hikes have pretty much been priced out now, the same as in the US. We're looking at June for rate cuts, and about 3 have been priced in for next year, which is pretty crazy. This could be a driver of that as well, of course. especially if the pound can regain some ground as well. If the pound can start getting back up to 1.25, that is a disinflationary pressure. So that would effectively mean that the potential for inflation to kick up again will actually be suppressed quite a lot. If you can get a fairly decent whack of a rise in the pound, then yeah, that should be quite a move. But overall, the way that I'm looking at it is it's a bit of a mixed bag, a lot being blamed on non-economic factors such as the weather. The rise in fuel prices is quite a short-term shock. I think if we see the demand side of things further out of the curve, the short-term shock has been, the OPEC supply cut, then the war briefly, and then now, the fact of the matter is that the demand just is not there going into January next year. So fuel prices, I think, should regulate themselves a little bit, but the BOE will be worried a bit. They will be not necessarily panicking, but they will be looking at this as like, okay, is this now a confirmation of a trend of reduced demand? Important data coming out of the Eurozone today as well. Their inflation data. HICP is Harmonized Index of Consumer Prices. It's a EU-specific measure, naturally, because it's a monetary union. They have to try and basically harmonize the data because otherwise all of the different countries would have different readings and it would just basically look a mess. But in effect, what we're looking at is getting back to target. 2.9% is, I guess, close enough to 2% compared to where it has been. Now, the one thing to note here is that the recent prints from the Fed, from the Bank of England, have all come in under expectations. So they've been soft, right? That's why we saw the equity market rally on what day was it? Was it Monday? Maybe it was last week. I honestly have lost track of time this week. But we saw the equity market rally based off of a softer inflation print. If we start to see, and it's very, very likely that we will see a soft inflation print out of Europe, because obviously German demand is completely messed up. They're a key driver of inflation in the bloc. Then I think that we are going to see a cap on the recent rally that we have seen in the euro. And I'm going to share this with you now. So you can see that we've started to trade. You can see yesterday, actually, it's had a pause already. This big old pin bar taking the previous 2 days high. I think we trade all the way back down to here, personally, 1.07. I think there's about 100 ticks in that if we get a softer print. And I think then we're going to be capped for a considerable amount of time. If you want to even look at, how some people might look at, supply and demand trading, this is where the market sold off previously. We've traded back into that sort of, I like to just think of it as resistance, but you can think of it however you like. Traded back into that level. This is the key low that it broke, and we're back at the same level. So we've broken a really, really major high from major low, from back in June, and actually 2 major lows from this origin. So this was the last previous major high in this market. And we've actually broken this low and then that low based off of this movement. So you can probably deduce that we should probably have some sort of targeting back down to here, potentially back down to the 1.05 level. But if we're coming hotter, then that's going to be a massive, massive surprise. And the outsized risk to reward then is to the upside. Personally, I don't really buy that. I just don't see how the macro backdrop or the fundamentals even of the euro can support a broader rally if based on the current conditions at all. I think if we get inflation in line or a little bit softer, we're really going to see the euro tank. So definitely something to watch out for. Hopefully this video can come out before 10 a.m. so that you can catch this and pre-prepare. So the last week or so has been a bit of a steamroller for dollar bulls. But based on the last video that I just mentioned, with regards to how I think the risk to reward is skewed in favor of a softer inflation print, and therefore the euro to be capped, it's important to be so brave at times of this, because you can note the probability change. You can see that the probability of something occurring is higher. But sometimes our mind can play tricks on us, whereby we think that just because something has had a really, really strong rally or a really strong sell-off, it means that it can't reverse and just go the other way as quickly. This is why it's so important to really, really back your ideas and really focus on the concept of risk to reward. Because in an idea like this, like the one that I previously mentioned on the euro, all we're looking for is a really fast reversion, which means that you can run a tighter stop. And if it does indeed have, a broader rally to the upside, you're out nice and quickly, but the thing with event-driven trading as well is that, yes, there's going to be liquidity stepping out of the market, so you might see a massive spike up first. But the fact of the matter is that if you're in small enough, you can get in right, close to where you would usually get stopped out, for example. And then as the market comes back your way, you can pyramid in a little bit more. So it's always important to be really, really brave and back your ideas if you think that a concept or a trade has a higher risk to reward than usual.